What is balance sheet and how to read it? A company has three main financial statements: the income statement, the balance sheet and the cash flow statement. In order to determine how safe an investment is, we need to pore over the balance sheet, and that's where the balance sheet, company equity, book value of shares and margin of safety can be found. One way to think about the balance sheet is to ask what would happen if the business liquidated itself right now. In that scenario, would the business sell all its assets and pay off all liabilities? In other words, the balance sheet is telling you how much the company owns and how much it owes. The answer to this question is known as equity. On a per share basis, equity is known as the book value. When the owner of a business wants to sell it, one way to determine the value of the business is to look at the equity. The larger the difference between the market price and equity, the riskier the business gets for an investor. A wide difference where the market price is a lot higher than the equity is equivalent to a low margin of safety. If the equity is very close to the market price of the business or even higher, there is, on the other hand, a high margin of safety. A value investor like Warren Buffett usually looks for a company with a high margin of safety. What is a balance sheet? The easiest way to think about a balance sheet is to consider what would happen if the ice cream business would liquidate right now. Imagine that the asset value of the ice cream stand is 10,000 Indian rupees, and the debt used to finance the machine is 9,000 Indian rupees. The remaining is 1,000 Indian rupees, which is called the equity. It's actually that simple. A balance sheet tells you how much the company owns, how much it owes in debt, and how much the owner would get if the company was liquidated. What is margin of safety? This is a very important concept for value investors to understand when evaluating how much they are paying for a business. On one hand, in your valuation, you don't want to pay too much for 1 Indian rupee profit. But on the other hand, you don't want to pay too much for 1 Indian rupee asset either. The less you pay for an asset, the wider your margin of safety is. What is total assets? The total assets is described as the total amount of assets owned by a company. In order to find this number, you'll have to check the balance sheet. What is total liabilities? Total liabilities are all the liabilities owed by a company, and you can find this number in the balance sheet. What is equity? The term equity simply means the total assets minus the total liabilities. If the company closed its doors and liquidated, a fancy way of saying they're going out of business, the equity would be the money that would be left after the company collected all their payments and paid all their debts. If you died today, the money your family would get would be your equity. Thanks for watching.